For 400 years, every market carnage has followed the same script. We look back at the Tulip Mania of the 1630s, the Roaring Twenties crash, the dot-com implosion, and the 2008 collapse, and we tell ourselves they were foolish. We are smarter now. But what if we aren't? The 20-year cycle of boom and bust is not an economic phenomenon. It is a psychological one. It is the greed cycle. And unless you understand the 4 predictable seasons of this cycle, you are doomed to be a passive passenger in it, watching your wealth be created and destroyed by forces you believe you cannot control. But what if you could see the script playing out in real time and knew exactly which season we're in right now? To understand the peak of the greed cycle, we must first begin in the Valley of Despair. This is Season 1, the scarring. Picture the landscape 2 to 3 years after a major crash. The financial headlines are bleak. The word collapse is still fresh in everyone's mind. Remember the retiree who lost half her nest egg in 2008 and swore off stocks forever? She's the archetype of Season 1. This isn't just an economic condition. It's a deep, collective psychological trauma. CNBC is a funeral dirge. Dinner party conversations avoid the word stocks like a plague. The very idea of investing becomes socially toxic. The investors who live through it are the once-bitten, twice-shy generation. Their dominant emotion is not greed, but irrational, bone-deep fear. This widespread terror creates the single greatest investment opportunity of the cycle. This is when the smart money makes its coldest, most calculated moves. This is when Warren Buffett is writing his "Be Greedy When Others Are Fearful" op-eds. This is when hedge fund managers are quietly hoarding shares of world-dominating companies, not betting on a quick rebound, but literally buying a dollar for 40 cents. They are accumulating while there is literally no competition from the general public. The market is devoid of euphoria. It is a market of pure, beautiful fundamentals. This phase is a long, grinding basing process where the smart money builds its position, waiting for the one inevitable catalyst, a new generation of investors with no scars, and the old generation slowly forgetting the pain. But what happens when that forgetting begins? What is the first subtle sign that fear is finally loosening its grip on the market's throat? As the scars of the last crash slowly heal, we enter Season 2, the rational ascent. Think 2003, 2007, after the dot-com hangover. The economy is genuinely recovering. Companies that survived are now leaner and reporting growing earnings. This is the phase where the foundation for the next mania is silently laid. It's not a dramatic explosion, but a steady, fundamentally driven climb. The P/E ratios that were in the single digits at the bottom begin to expand, but they remain within historical norms. This is the golden age for the disciplined investor, the person who had the courage to buy at the bottom. They are being rewarded not for speculation, but for patience. It is during this phase that a new technological trend begins to capture the public's imagination. We see it every cycle. The personal computer era gave way to the smartphone, which now gives way to the promise of AI. Initially, the companies driving this trend are valued on their actual profits. But as their success stories dominate, a subtle shift occurs. The conversation starts to change from what these companies are doing to what they could do. The language of analysts subtly shifts from earnings per share to total addressable market. The solid ground of present reality begins to soften, making way for the intoxicating quicksand of future potential. This is the critical inflection point. The healthy bull market built on value is about to be hijacked by its older, wilder brother, pure, unadulterated greed. But what are the undeniable signs, the specific headlines and behaviors that tell you rationality has been thrown out the window and the true mania has begun? This is the point of no return. Season 3, the euphoric peak. This is where rational investing dies and irrational exuberance is born. The steady, fundamental climb transforms into a vertical, parabolic moonshot, completely untethered from reality. How does this happen? It starts with a few viral, life-changing gains. You know the clip. The college student who turned $5,000 into $500,000 on a meme stock like GameStop. That story is gasoline poured on the fire of FOMO. It's no longer enough to see steady growth. You see others getting 1,000% returns, and the psychological pressure becomes unbearable. You feel stupid for being cautious. This is when the "this time is different" narrative becomes a mainstream religion. Skeptics are shouted down as dinosaurs. New valuation metrics are invented to justify the insanity. In the dot-com bubble, it was price to eyeballs. Today it's price to potential, a metric where the potential is always, conveniently, infinite. The final, unmistakable signal is the capitulation of the retail crowd. Your Uber driver is giving you stock tips. Crypto bros on Twitter are hailed as financial oracles. People who have never read a balance sheet are quitting their jobs to become day traders, convinced they've found a cheat code. This is the greater fool theory in action. No one is buying for value. They're buying to sell to someone even more foolish tomorrow. Credit floods the system as people take out second mortgages and max out credit cards to amplify their bets. The market is no longer a place for capital allocation. It's a global casino. And at the very peak of this mania, when optimism is absolute and everyone is all in, the pool of greater fools finally, inevitably, runs dry. The last one is bought, and that is the precise moment the entire fantasy shatters. But what does that shattering actually look like? And why is the crash that follows so much faster and more violent than the climb? And just like that, the music stops. We now enter Season 4, the devastating tumble. The transition from euphoria to panic is not a slow fade, it's a violent, jaw-dropping rupture. It begins with a catalyst, a missed earnings report, an inflation shock. Then the margin call cascade begins. Picture this. An investor who borrowed heavily to buy stocks at the peak gets a notification, a margin call. They must sell immediately to cover their debt. That selling pushes prices down, which triggers margin calls for 10 other investors. They are forced to sell. Prices fall further. It's a financial domino effect. Selling forces more selling. The fear becomes contagious. Denial turns to panic. Retirement accounts hemorrhage value. The average investor who bought at the peak finally capitulates. They log into their brokerage app, hands shaking, and hit sell all at any price, transforming paper losses into a locked-in, life-altering reality. It is this final wave of panic selling that creates the ultimate bottom. The very greed that fueled the ascent now fuels the collapse, transforming into its equally powerful twin, blind, unstoppable fear. And as the dust settles and the financial ruins smolder, a haunting question emerges. If this cycle is so predictable, why does it feel so uniquely terrifying when you're the one caught inside the storm? So why does this 20-year amnesia grip us with such relentless consistency? The answer lies in the brutal mathematics of memory. Financial pain has a half-life. It decays roughly every 20 years. The people who felt the searing pain of a crash who lived through 1929 or 1987 or 2008 eventually retire or step away from the markets. Their cautionary tales become just that, stories. New generations arrive unscarred, armed with new technology and the unshakable belief that they've discovered a new paradigm. Look at the timeline. The survivors of the 1929 crash were gone by the speculative 1950s. The sting of the 1970s bear market had faded by the dot-com 1990s. And the trauma of 2008, for today's new investors, it's a distant historical event, not a personal financial wound. This generational transfer of ignorance is the engine of the greed cycle. The memory of the crash fades, but the underlying human psychology does not. The slate is wiped clean, and the cycle is primed to begin again. But knowing this raises a terrifying prospect. If we are all doomed to repeat the mistakes of the past, is there any way to break free? Or are we simply prisoners of our own DNA? So, are we doomed to be perpetual victims of this 20-year greed cycle? No. But escaping it requires you to do the one thing that feels most unnatural. You must become a contrarian to your own instincts. The antidote is a disciplined, systematic process of doing the opposite of what the herd is doing. And it starts tonight. Write your personal investing constitution. Make it simple. Make it unbreakable. Rule 1. Sell a set percentage of any position after it gains 100%. Take profits systematically. Rule 2. Maintain a minimum cash buffer, 10%, 15%, and add to it aggressively when the market is frothing. This is your dry powder for the crash. Rule 3. Commit to dollar cost averaging into high-quality assets during a downturn, no matter how scary it feels. This is emotional arbitrage. You are systematically buying when there is blood in the streets and selling when there is champagne in the boardrooms. The goal is not to perfectly catch the top and bottom, but to avoid the catastrophic mistakes of buying at the peak and selling at the bottom. The greed cycle will always turn, but you no longer have to be crushed by its wheels. You can learn to step aside, and then, when the wreckage is cleared, you can be the one to walk forward and claim the treasures left behind. The final question is this. Will you have the discipline to be frightened when others are greedy and greedy when others are frightened? Your financial future depends entirely on your answer.